Backdoor Roth conversions give me the sads. People love to talk about this. It sounds so alluring, but in short, they give me the sads because there's hair on it. Anytime you are trying to do a tax avoidance tactic, there's always hair on it. So, what is a backdoor Roth conversion? It's a way for people who earn too much money to still put funds into a Roth IRA. A Roth IRA is a savings vehicle like a traditional IRA, except that when you put the money in, you put it in after tax dollars. So you don't get a tax benefit today, but long term in the future, you do, because that money and any money that accumulates through growth is not taxable when you pull it out, if you pull it out after 59 and a half. However, normally, if you make too much money, the IRS does not let you contribute to a Roth IRA directly. Here's how a backdoor Roth conversion works and why people do it. First, you put money into a traditional IRA, which has no income limits for non-deductible contributions, and that's the key. The money you put into the traditional IRA is non-deductible, meaning it's after-tax dollars. You don't take the deduction. If you put it in pre-tax, then it defeats the point. Then, later on, you convert that money into a Roth IRA. Basically, you're just flipping the title. You're going from a traditional to a Roth, and since you've already paid income tax on that money, it doesn't prevent you from contributing. There's no income limits there. So this lets your money end up in a Roth even though you wouldn't normally qualify. So why do people do it? Well, it seems obvious, but I'll state the obvious. It's big benefits. It's tax-free growth. Your money grows tax-free, and you won't owe taxes when you take it out in retirement, 59 and a half or later. No RMDs. Roth does not require you to take money out when you hit some arbitrary age as per the IRS, which is true with a traditional IRA. Tax flexibility, so it gives you diversification. A lot of people have accumulated a tremendous amount of assets in pre-tax vehicles like 401ks, IRAs, SEPs, simple IRAs, and so on. So the first rule is called the 5-year rule. And the 5-year rule is if you take money out of a Roth IRA before 5 years have passed after a conversion, you pay a 10% penalty unless you're over that 59 and a half threshold. The order of withdrawals is the second funky rule. Roth IRA monies come out in a specific order. Number one, the contributions. That's the first thing that comes out, the money you put in. This part is always tax-free and penalty-free. Then the converted amounts come out. Could be taxed or penalized if you take it out too early. And then number three, earnings, growth on your money, taxed if you take it out before the age of 59 and a half and before the 5-year rule is met. There's my favorite, the pro-rata rule. Nobody talks about this. So if you have any pre-tax money in other traditional IRAs, the IRS mixes it together with your after-tax contributions when you convert. So this means, in English, that part of your backdoor Roth conversion could be taxed. So for example, if you have $90,000 in a pre-tax IRA and $10,000 in an after-tax IRA, the IRS says 90% of any conversion is taxable. In other words, you can't cherry pick the money that is going to be taxable or non-taxable. It is easy to screw up. Is it worth it? Maybe, but this is where you bring in subject experts. You talk to a financial advisor, you talk to a CPA, you look at your current circumstances and you figure, is it going to be worth the hassle that I'm going to have to deal with this proportionality thing? Or are there other things I could be doing to save in a more tax diversified, efficient manner? If you think what I say is interesting or helpful, please be sure to like, to share, to comment, and to subscribe. I'm Jennifer Kirby from Talisman Wealth Advisors. I'm a financial advisor seeking to provide insight on financial matters, including planning, straight up money, and investments.